No, I really appreciate the opportunity. It's a little late. We get up early here, but thank you again for the opportunity to present to everybody. Look, I'm really excited about being on the panel and demonstrating a little bit of how the business really addresses a systemic problem that's going on in the United States. We have over 120 million people that are credit challenged. They either have an impaired credit score or no credit score, and they're typically have been relegated for the last 40 years to high cost predatory product financing alternatives that end up costing them 200 to 400% over market. uh, the 47% of US adults don't qualify for mainstream credit. They don't have credit cards. They don't qualify for the buy now, pay later. They're really left to three big industries: payday lending, which charges 400% APR, rent to own or lease to own, that you can buy $1,000 couch and end up paying $3,800 in the state of California for a limited SKU selection and a used good. So we basically, or I developed, I'm the founder and CEO of the company, and we're a very mission-driven company to disintermediate these predatory alternatives and give the 120 million credit challenged consumers an ability to buy now and pay over a reasonable period of time, which is 6 months. So Zebit is an e-commerce company. We are the retailer. We make our money, the difference between how we source a product, which I'll talk about, and the competitive price we put up on the market. So the GMV, when I'm talking about GMV, this is our GMV. We don't make a commission off of it. So we were founded in 2015. We raised about $75 million of equity capital. Part of that, about 24.5 million from the Australian exchange. We were recently listed in October of last year, brought together a really experienced team around e-commerce, lending, credit risk, and how do you disrupt models. And we've been in existence having 100% year-over-year growth right up until sort of COVID hit. If you guys could go 2 slides, and I'll talk a little bit about the model. You can go to the next one. There you go. So there's really 2 sides of the business. There's an e-commerce side of the business, and I'll talk a little bit about that. And then there's the credit side, because we have developed or really reinvented how product financing can be done for the vast majority of US adults in the United States. And we have a proprietary machine learning based credit solution that is our own, in order to determine the risk of a customer, how to understand their identity, their employment and income, and how to allocate a line. But on the e-commerce side, we're set up in a very streamlined way. We're a 100% dropship model. I have over 120 different suppliers across 25 different product categories: electronic, furniture, home, jewelry, fragrance. It is a one-stop shop for our consumer set, but we have none of the gross margin eating activities that a normal e-commerce retailer would have. We don't buy inventory in advance. I don't have the concept of warehouses, returns, discounting, etc. What we have is credit risk. So we acquire our customers through 3 big categories: direct to consumer, whether that's Facebook or paid search. We're launching our first TV commercial in mid-April, so we're really excited about that. To B2B and partnerships, where we're integrated to the largest benefit platforms in the country, so employees can see what we offer, click to our site, register within 90 seconds to 2 minutes, and get approved so they can have a spending limit to come into our marketplace and shop. And of course, we haven't spent a lot of money on brand, or if anything, but historically we've had viral acquisition of about 24% year over year, where we're basically getting customers for free. And why is that? Because we've had an incredibly predatory set of competitive alternatives for this customer base that preys on them with interest, fees, and penalties, traps them in a cycle of debt. The products are structured to fail. Zebit does none of that. We have a white hat, transparent offering to give to customers without any kind of safety net in charging them interest, hidden fees, or penalties, even if they fall off the bandwagon. So as we acquire customers, we bring them to our site. Everything we do is done electronically online. We have a mobile responsive site. Soon we'll be putting out an app, but we have about 98% of our customers that already transact with us mobilely. They come on, our machine learning models are taking over 4 million applications, external data, internal data, really underwriting in two steps. We're underwriting their identity, their employment, their income, really assessing the affordability. Now, this customer is typically a risky customer that if you give them a $1,000 cash loan, about half of them won't pay you back. We've totally transformed that here with our machine learning underwriting and being able to take an incredibly risky customer and graduate them over 6 months, 1 year, up to 5 years, where we've had clients on the platform, where they look like a reliable shopper who pays back just like a prime customer. So there's been no company that I know of in the history of humankind that's ever been able to make a profit off of this consumer base without having some sort of predatory gotcha. So when you're approved online, you get dropped into our marketplace. And our marketplace is a closed shopping site where we're actually modeling all of the consumer behavior to determine the risk. And so as a customer is shopping, going from electronics to home, fragrance, et cetera, we have models that are analyzing the behavior and making a decision at the point of sale. And the models are making different decisions for a customer that's new to us, customer that's been on the platform for 6 months and paid off an order, or a customer that's been with us for 5.5 years and might have placed 200 orders with us. The models govern whether we ship the order or not. About 99% of our customers are on auto pay tied to a debit card, so we don't use any kind of predatory payment mechanism like ACH. Just alone in 2019, there were $66 billion in the United States of interest, fees, and penalties. 26 billion was hitting a customer's bank account when there was no funds. And that produces a non-sufficient funds charge of anywhere from 15 to 105 bucks. So we've eliminated anything that would do harm to the customer. We understand where they're employed, when their income actually comes in, and we align their retail installment sales agreement with their pay dates. So everybody pays something at checkout. It's typically 20 or 25%. We finance the rest over 6 months according to their pay cycle. And then, as I said, most of the people are on auto pay. If somebody falls off the bandwagon, they don't pay, system automatically freezes them. If they cure, there's no harm, no foul. They get their spending limit back and they can continue to shop. We see really an extraordinarily long LTV to CAC. And I've been doing this for 30 years across e-commerce and fintech, et cetera. I've been with some of the top e-commerce companies, I think, in the world, but I've never seen a customer that actually we can acquire them extremely cost effectively. We pay back their fully loaded marketing costs within 11 months. And here in the US, 12 months is the gold standard. They buy again and again and again, consolidating their share of wallet. And we only have to acquire them once because there's no reason, they already have access to the market. And they pay us back through their loyalty and their patronage. And as they graduate, their expected losses are actually going down. So we have a very sticky customer with a very high LTV to CAC that's honoring us with their repeat purchases and actually telling their friends and family about us, since we have no incentive program to drive refer a friend in. The next slide would be great. So we came out in October 2020. We were originally scheduled to do the IPO in May of last year, but then COVID hit and we called off those plans, given the capital markets closed sort of in March. We put out a 12-month, pretty aggressive prospectus forecast at a time where nobody was giving guidance. We recently, I think as everybody knows, we put out our Q3, our Q4, our H2, and our FY20. We beat our forecast handily on all of the key metrics from a revenue standpoint, from a contribution margin standpoint, and from an EBITDA loss standpoint. We continue to see strong growth during Q1, and our guidance hasn't changed. We look forward to reporting that to the market at the end of this month. And then at our AGM meeting, we'll have even more guidance relative to the next part of the year. Next slide. So just to give you guys an opportunity to understand, like, what are we doing next? There's basically 3 themes that we're really working on. One is really increasing the channels by which we acquire customers. Now we've gotten to be a $87 million revenue company because, again, GMV is our revenue. We recognize revenue at the point of delivery. And we've built a lot of very scalable channels, but we are already testing new channels like TV and podcast, and we've just implemented one of the largest affiliate platforms in the country, where we're able to get one-to-many affiliate relationships versus us cutting it deal by deal. So we're really focused on new channels. And why are we doing that? Because we want to be able to plow more marketing dollars in and get this business to break the plane of profitability on a full year basis and bring that time horizon in. We're also looking at optimizing. There's a lot of value on the table when you're a startup and you're leaving these little value pools, but now's the time to actually grab that. We certainly have enough demand from an application perspective. And so we're always looking at how do we increase approval rate, lower our cost of acquisition, use new data that we're constantly retroing against new data sets externally and internally to increase approval rates to get more customers on the platform. We've already made some pretty remarkable strides in that in Q1, and we'll be putting that out in our 4C. The other thing that we're doing is we're really deepening the product selection. So we've had customers on the platform for almost like 6 years now, continuing to buy with us on a weekly and monthly basis. And so while we have 25 different product categories, where we have the largest wholesalers, distributors, and manufacturers on the platform, we're also adding a couple of different categories that I'm going to be very excited about introducing to customers no later than June. We're adding Zebit Grocery, right? Because we saw big demand during COVID for that. So we have access now. We've cut a partnership with Unilever. We have access to over 35,000 SKUs across dry goods, refrigerated goods, and frozen goods to be able to offer our customers, which we think is going to be an excellent way to deepen the product assortment and deepen the relationship we have. And we've also really just brought on our first Australian e-commerce company, The Half, where we're now live on the site selling Australian dresses. And the commitment that I have is we operate only in the United States. We are a foreign listed company on the Australian exchange. But if I could help Australian e-commerce companies find distribution in the US to give them an opportunity to sell to our customers where they have no marketing costs, no transaction risk, they just have to be able to ship the product, then we're definitely open to do that as a way to give back. Lastly, look, we're always interested in governance. We have pretty much our entire board and myself going through governance training so we can understand more of the nuances of being an Australian listed company, as well as at the end of this year, it is our intention to actually pilot Zebit for UpCredit customers. There is a lot of demand in buy now, pay later for the 4 payment model. We think bringing a 6 to 12 month model, leveraging our infrastructure might be an interesting way to have a natural adjacent revenue stream in addition to the massive market that the credit challenged consumer base already offers us in the US. So I'm happy to take questions. I see Tim is on, so I'll be disciplined in turning it over to him.
Thanks, Mark. Great presentation. I mean, one of the things we learned today is all these buy now, pay later models are very different. And particularly, I mean, the question is, do you actually consider yourself a buy now, pay later business model, particularly given you've got such a positive social impact?
Yeah, I mean, the whole business is around an ESG methodology. I mean, I was my customer when I was growing up. I faced the challenges they face with poverty, homelessness, et cetera. We're not a buy now, pay later company. I mean, we are an e-commerce company that is using data science to de-risk a customer. We're more of an analytics company or an e-commerce company with an analytics framework. And we service a very different customer base than anybody else because there is no off-the-shelf credit solution that gives you insight on the propensity for this customer to pay you back. We've spent 5 years developing proprietary models, proprietary data in order to service this customer. And I think we have an immense head start on how to do it and build some really deep technological moats around it. Now, can somebody else do the e-commerce stuff better? Yeah, I mean, an Amazon, a Walmart, a Target, they have more scale than us. They'll get more margin out of that. Can they actually service the credit challenge base the way we do? They can't. So as we continue to grow the business and gain more scale, we'll actually increase our own purchasing power with the supply chain, in the US and outside of the US.
And I suppose that becomes an argument around margins. There's a question here about, what are your product margins as a retailer?
Yeah, no, I'm happy to share it. So it depends by product. The average gross margin in 2020 was above 26.3%. Now, furniture is usually a 50, 60% gross margin, whereas electronics is much lower. You have tires and jewelry, sitting in the mid 30s, et cetera. But from a blended average basis, it was about 26.3% in 2020. We're expanding our capabilities along furniture to get to have what we call LTL, or less than truckloads delivered in home, room of choice, so we can expand higher gross margin products to our customer base. But that is what our gross margins are.
And I mean, COVID was a kind of a market of extremes. You had a lot of people lose jobs, then you had this market stimulus come in. Is there any anomalies in your kind of bad debt data that you've seen over the last 12 months?
Yeah, I mean, that's an excellent question. So, if we went back to the slide where you saw, bad debt was 10.5%, that is not a normal steady state for our business. The prospectus forecast put out 14.9%. So we're getting better at modeling, but there's also a structural element of our business. Because we have heavy repeat revenue from tenured customers, that revenue is already de-risked on their own, down to the expected bad debt on a lot of those customers is in the 2 to 5% range. The bad debt that we experienced in 2020 was definitely aided through the stimulus. Okay, now that's sort of a bad debt range, 10 to 12%, that we would get or expect to have when we reach profitability, when our revenues are sort of in the $225 million range. So look, in the first half of this year, my expectation, given the stimulus came out in March, and it's untargeted stimulus, people that are employed and unemployed are getting checks. 80% of my employees that are very representative of my customer base got $5,000 checks for a family of 3, even though they're employed. So we expect bad debt to continue to be below forecast because of the stimulus. It's hard to isolate it exactly, but we know that we're experiencing lower bad debt than expected. But we also see, if we take out some of that positive interaction, we see our models are actually doing the right things to make the right decisions.
And I mean, there is a strong focus from the investment community on positive social impacts. Your clients have generally been victims of predatory lending, as you've said. Can you change their credit ratings, and is there something at the end that actually can turn that customer into something better?
Yeah, that's a really, really good question. So we use a carrot instead of a stick. Most lenders or credit providers, remember, we don't give cash; we just give store credit to our e-commerce site. We give larger lines, lower down payments at checkout, and more term and more product selection. So we're rewarding our customers for on-time, financially responsible behavior. We are going to be bringing on a new data asset where we're going to be what's called furnishing data back up. Now, it's not furnishing data back up to the 3 bureaus in terms of FICO, because we don't pull the FICO score because it doesn't really lend a lot of insight into this customer base. And actually, one of my board of directors was the founder and CEO of FICO, and he's been with this business for 5 years. So, but we will be furnishing data to alternative bureaus, which will help people get better access to lower cost credit in terms of if they wanted to get a dollar-based loan that we don't offer. So we're trying to have a positive impact, not only around giving a transparent offering, price competitive offering, grow your line with us, but also we will be this year being reporting to certain alternative credit bureaus that should help people get better access to overall credit over time.
And just one more question before we go. Does the approval process limit the product availability, or is that done on each purchase at the checkout?
No, that's a great question. So when somebody's approved, they're getting a provisional line of credit. Let's say they get $1,000 to spend in the Zebit market. It's not obligatory. If they spend $500, they actually don't get that $500 replenished until they pay it off over 6 months. So the product is structured to be financially responsible and not tip a customer over. They get access to all of the products that we sell to the general consumer base, but our more mature tenured customers get access to special products that we don't offer all the time. And those could be lower gross margin. Why? Because they're lower bad debt customers that are generating a targeted contribution margin. But by and large, every customer is getting access to the 100,000 active SKUs across 25 different product verticals, and everybody will get access to this new introduction of Zebit Grocery in the June time horizon.